Silver has just shattered every record in history. The price is currently sitting at $61.86 per ounce. That is not just a new high, that is uncharted territory. The previous record of $50 was set back in 1980, which was 45 years ago. But the price tag is not the real story here. The real story is what is happening right now in the skies above the Atlantic Ocean. As I record this, China is airlifting silver across continents. In October alone, 660 tons of physical silver were loaded onto cargo planes from Shanghai and flown directly to London. Why would they do that? Because the vaults in London are running dry. The global supply chain for this metal has snapped. The Federal Reserve just cut interest rates today, making precious metals even more attractive. Social media is exploding with predictions of silver hitting $80 or $100 or even higher. If you invested $10,000 in silver on January 1st of this year, you would be sitting on $19,000 right now. That is a 100% gain in 12 months. It is crushing the stock market. It is crushing gold, which is only up 56%. So here's the question everyone is asking. Is this the boy who cried wolf, or is the wolf finally here? Because I need to tell you something very important. I have seen this movie before, 3 times actually, and every single time it ended in disaster, until maybe now. That is what we're going to figure out today, because whether you own silver or not, what is happening in commodity markets right now will affect your money in the months ahead. This is not financial advice. This is education based on cold, hard history. And by the end of this video, you will know exactly how to think about what comes next. Let us dive in. To understand why 2025 is so dangerous, we have to go back to the graveyard of history. Our story begins in the 1970s with 3 brothers from Texas, Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt. The economy back then was a mess. Inflation hit 13.5%. There were gas lines, the Iranian Revolution, the Soviet invasion of Afghanistan. Chaos was everywhere. The Hunt brothers looked at this and decided that paper money was doomed. They decided they needed silver. In 1973, they started buying at $3 per ounce. That seemed reasonable at first, but it quickly became something else. It became an attempt to corner the entire global market. By 1979, they controlled over 100 million ounces. That was roughly 1/3 of the global supply available at that time. Think about the audacity of that. 3 individuals controlled more silver than most governments. And here is what happened. In January 1979, silver was at $6 per ounce. By January 1980, silver hit $50 per ounce. That is a 713% increase in just 12 months. Their paper fortune was in the billions. Tiffany & Company was so outraged by the high prices that they took out a full-page ad in the New York Times condemning the hoarding. Then the regulators stepped in. The exchange enacted Silver Rule 7, which restricted new long positions. But the real collapse came on March 27, 1980, a day that would be known forever as Silver Thursday. The Hunts had been using massive leverage, which means borrowed money, to control their positions. As prices began falling, they faced margin calls they could not meet. On March 27th, they failed to meet a $100 million margin call, and the market imploded. In just 4 days, silver crashed over 50%, falling from $21 to under $11. The Hunt brothers lost $1.7 billion almost overnight. By 1988, they were convicted of market manipulation. They were fined $10 million each, they were banned from commodities trading for life, and they filed for bankruptcy. It was one of the largest bankruptcies in Texas history. Silver itself crashed 90% from its peak, falling to $4.90 by 1982. The lesson from 1980 is undeniable. You cannot manipulate markets forever. No matter how much capital you have, when the scheme unwinds, it unwinds fast. Gravity always wins. Now, you might think, but that was 45 years ago. Surely we have learned something since then. We have not. Fast forward to 2011. The world was reeling from the 2008 financial crisis. The Federal Reserve was printing trillions of dollars in quantitative easing. Fears of hyperinflation were rising. People believed the dollar was collapsing. Silver went from $30 to $49.45 in just 4 months. Everyone said this time is different. Everyone said we have real inflation. Then on May 1st, 2011, it all fell apart again. Silver crashed 30% in just 5 days, dropping down to $34. But it did not stop there. Over the next 4 years, it fell all the way to $14. That was a 71% decline from the peak. If you bought at the top in 2011, you did not see those prices again until 2024. That's a 13-year wait just to break even. The lesson from 2011 is clear. Monetary policy alone is not enough. If the price rally is driven mostly by speculation and not by real industrial demand, the collapse is swift. Fear is a powerful motivator, but it is temporary. Now let's look at 2021. This one is even more pathetic. The Reddit group Wall Street Bets had just squeezed GameStop stock from $20 to $500. Hedge funds lost billions. The retail investors felt like David beating Goliath. Emboldened by this victory, they turned their eyes to silver. They declared that silver was the next big squeeze. On January 28th, silver was at $25. By February 1st, silver hit $30. That was an 8% surge in a single day. But by February 8th, it was back to $26. The squeeze fizzled out in days. Why did it fail? Because GameStop was a company with a $2 billion market cap. The silver market trades $1.5 trillion annually. It's too big. The squeeze was hype without substance. So there you have it. 1980 was manipulation, and it ended in a 90% crash. 2011 was speculation, and it ended in a 70% crash. 2021 was social media hype, and it ended in immediate failure. Which brings us back to today, December 2025. Silver is at all-time highs of nearly $62. Are we just repeating history, or is something fundamentally different this time? Let's look at the pattern. 1980 lasted 2 years. 2011 lasted 4 months. 2021 lasted days. And now, in 2025, we've had 12 months of sustained gains resulting in a 100% increase. This rally is not being driven by 3 brothers from Texas. It's not being driven by fear of the dollar, and it's certainly not being driven by a Reddit forum. This time, the rally is driven by an actual supply shortage. That's the difference. Every other time in history, it was smoke and mirrors. This time, there is literally no silver left in the vaults. Let me show you exactly what I mean with the numbers. For the past 5 consecutive years, the global silver market has been in a deficit. That means demand has exceeded supply every single year since 2020. The numbers are staggering. The projected deficit for 2025 is between 149 million and 215 million ounces. This is the largest single-year deficit on record. If you look at the 7-year cumulative deficit, it's over 1.2 billion ounces. Think about that number. More than 1 billion ounces of silver have been consumed beyond what was produced by the mines. Where did that extra silver come from? It came from existing stockpiles. It came from the vaults in London and New York. It came from reserves built up over decades, and now those reserves are running dangerously low. Meanwhile, mine production has actually declined by 1% year over year, and here's why that matters. Most people don't know this, but silver is primarily a byproduct. About 70% of all silver comes from mining copper and zinc and lead. It doesn't come from dedicated silver mines. When the economy slows down, base metal mines shut down. When copper mines shut down, silver production falls as a side effect. You can't just turn on silver production like a faucet. Opening a new mine takes 10 years of permits and construction. But here's the most important shift. This is the factor that makes 2025 completely different from 2011. Industrial demand now accounts for over 60% of total silver consumption. In 2011, it was only 50%. This is not jewelry. This is not investment speculation. This is the infrastructure of the 21st century economy. And simply put, there is not enough silver to build it. Three specific forces are devouring silver faster than it can be produced, and these forces are not going away. Number 1 is solar panels. Number 2 is electric vehicles, and number 3 is artificial intelligence data centers. Let's break these down one by one because the mathematics behind this demand is what validates the price of $60.
First, let us talk about solar energy. In 2025 alone, 20% of all global silver supply is going into solar panels. That is 200 million ounces. China produces over 90% of the world's solar panels, and they are installing them at an unprecedented rate. They are currently building enough solar capacity to cover an area the size of the state of Texas. But here's the critical part that most investors miss. Once that silver is put inside a solar panel, it is effectively gone for 25 to 30 years. At current prices, it is not economically viable to recycle silver from old panels. So this demand is cumulative. It keeps building year after year after year. New technologies like TOPCon and HJT solar cells actually require even more silver per unit than the old technology. Second, let us look at electric vehicles. Each electric vehicle uses 2 to 3 times more silver than a traditional gas car. A typical EV contains about 25 to 50 grams of silver in its various electrical components. Global EV sales are projected to hit 20 million units in 2025. That translates to hundreds of millions of ounces going into vehicles that are driving on the streets right now. Third is the rise of artificial intelligence and data centers. Every new AI training cluster, every new 5G tower, every new chip fabrication plant, they all require silver. Why? Because silver is the most electrically conductive metal on the periodic table. In the world of AI, speed and efficiency are everything. You cannot build high-speed infrastructure with copper alone. You need silver for circuit boards, antennas, and server connections. This industrial demand is not speculative. It is not going away just because market sentiment shifts. Solar panels need to be built to meet energy goals. EVs need to be manufactured to meet government mandates. 5G networks need to be deployed for communication. This is structural, persistent demand that cannot be easily substituted. There is no good replacement for silver in most of these applications that offers the same combination of conductivity and cost. Remember that airlift I mentioned at the beginning, the one where 660 tons of silver were flown from Shanghai to London? That happened because the London precious metals vaults were running critically low. To prevent a complete breakdown in their delivery system, they had to airlift massive quantities of metal across continents in an emergency.
I've covered commodity markets for years, and I've never seen anything like this. When the world's largest financial centers are using cargo planes to move metal in a panic, that is not a bull market. That is a crisis. On November 28th, there were reports of system strains at the CME exchange during silver delivery notices. The market price gapped up 5.53% the very next day. The Shanghai vaults have plummeted to their lowest level since 2015, draining 29 tons per week. The silver market has been in a state called backwardation. This is a technical term that means people are willing to pay more to get silver right now than to wait for future delivery. Backwardation is the ultimate signal of acute physical scarcity. So let me summarize the core distinction between 2025 and all previous rallies. Previous rallies were driven by actions that could be reversed. Sentiment can change, regulators can change. But 2025 is driven by a mathematical reality. Demand exceeds supply, and the deficit is structural. In 1980 and 2011, the smart money was selling into the hype. They were taking profits from retail enthusiasm. In 2025, smart money is dealing with a procurement problem. Industrial companies genuinely need the metal to keep their factories running. They are competing for limited supply. That is not hype. That is supply and demand.
Now, before you rush out and buy silver, let me pump the brakes hard. Even fundamentally driven rallies can correct sharply. Silver is up 100% in 1 year. That is an enormous move. Even if the long-term trajectory is higher, a 15 to 20% pullback from $60 would take us back to $48 or $51. That would be painful for anyone who bought near the top. Here are the 3 ways this could still blow up in your face. Risk number 1 is a recession. Remember that 60% of silver demand is industrial. If the global economy tanks, demand craters faster than supply can adjust. Solar projects lose financing, EV sales decline as consumers tighten their belts. In a deep recession, industrial demand destruction could overwhelm the supply deficit story. We saw this in 2008 when silver crashed 50% despite strong long-term fundamentals. Risk number 2 is regulation. Remember that both 1980 and 2011 ended with rule changes. If banks holding short positions face serious stress, regulators will intervene. They always change the rules to protect the system. Risk number 3 is you. Human psychology is powerful. A 20% correction from here will shake out everyone who bought due to fear of missing out. Are you prepared to hold through that? Many investors who bought silver at $30 are now sitting on double their money. The temptation to take profits is enormous. So, what should you do? Here are the key indicators you need to watch. First, watch the Shanghai inventory levels. If they keep dropping, that is bullish. If they start to rebuild, that is bearish. Second, watch solar panel production data from China. This is a leading indicator of industrial demand. Third, watch Federal Reserve policy signals. This determines the strength of the dollar. And here is how to think about your strategy. For long-term holders, if you believe the supply deficit thesis, volatility is just noise. Consider dollar cost averaging. Do not go all in at once. For traders, use tight stop losses. Take profits on rallies. Do not fall in love with your positions. For those on the sidelines, waiting for a pullback might be wise given the 100% rally we have just seen. A correction to the low 50s would offer a much better risk-to-reward ratio. I will leave you with one of the most important investment quotes of all time from economist John Maynard Keynes. Markets can stay irrational longer than you can stay solvent. The wolf might be real this time, but that doesn't mean you won't get bitten if you are not careful.
You can be right about the fundamentals and still lose money if your timing is wrong or if you are over-leveraged. The question isn't whether the supply crisis is real. It is. The question is whether you can handle the volatility on the way up. Because if history teaches us anything, it is this: you can be right about where we are going and still lose everything on the journey. The wolf is here. Just make sure you do not let him eat you. Class dismissed.